Hi, everyone. I'm Jen Schlaak with Three Keys Real Estate Group at Keller Williams Preferred. Today, we're cutting through the noise to talk about what's actually shaping the 2026 housing market so you can make confident decisions instead of reacting to the dramatic headlines. So, what I'm seeing with my clients here in the South Metro really lines up with what housing analysts are saying. We're entering a new kind of market. Rates are shifting, inventory is loosening, and opportunity looks different than it did in 2022 or 2023. Here's what we'll cover: where mortgage rates are heading and why they don't always follow the Fed, how inventory and pricing are evolving, and where buyers and sellers and investors can find real opportunity heading into 2026. So let's start with interest rates and affordability. Current data for November 2025, we're looking at the average 30-year fixed mortgage rate. We're falling between 6.1 and 6.4%. Mortgage News Daily is putting us at 6.28%. Bank rate puts us at 6.26%. Most of my buyers today are locking in around 6.25 to 6.375%, depending on their credit, debt to income ratio, loan type, and whether they're purchasing points to buy down their rates. So let's talk about mortgage rates and why they don't always follow the Fed. While mortgage rates are influenced by the Federal Reserve, they actually move more in response to inflation trends, investor confidence, and employment data and job growth. So in other words, the Fed sets the tone, but the market decides the rhythm. When job growth is strong, the economy is running hot, keeping inflation rates higher. When job growth cools, inflation pressure eases and mortgage rates typically drift lower. Right now, U.S. job growth has clearly slowed. Unemployment hovers near 4.2%. Monthly payroll gains have moderated to roughly 70 to 80,000 new jobs. The labor force participation rate remains modest, around 62%, and job openings have eased to roughly 7 to 8 million. So job growth is still healthy, but no longer overheated. And this cooling labor picture helps ease inflation pressure, which is why analysts expect mortgage rates to hold steady or very gradually improve through 2026 rather than surge higher. A big influence on investor confidence right now is the AI factor. Artificial intelligence is disrupting the labor market, creating uncertainty around jobs and data. And since labor and inflation move together, that unpredictability keeps investors cautious and rates steady. So let's talk about what's forecasted for rates. Fannie Mae and Mortgage Bankers Association project 30-year fixed rates around 5.5 to 5.8% by late 2026. So they're anticipating a modest and gradual drop over the course of the year. So to put that into perspective, if you're dealing with a $375,000 mortgage, your 30-year fixed rate principal and interest payments at 6.5% on that $375,000 mortgage would be $2,372 per month. At 6% on that $375,000 mortgage, you're looking at $2,249 per month. So that's a savings of $123 a month. Just to give you an idea. So that's a significant chunk of money for most people. So today's rates, today's rates were at about 6.1 to 6.4%, and analysts forecast that we'll be seeing very gradual improvement over 2026, and we can expect a steady market, not a boom or a bust, but just a steady market. So let's talk about inventory and pricing trends. So a snapshot of Minnesota. Minnesota has roughly 22,346 homes on the market. So that's a 5.7% year over year increase. We're looking at about a 2-month supply, which is still below the 4 to 6 months, which is considered a balanced market. So this lack of inventory means sellers still have leverage, but buyers finally have a bit more breathing room. One thing that's having a big impact on inventory is what analysts are calling the lock-in effect. So to explain this, during the 2020 and 2021, millions of Americans were refinancing, or they bought a home with a mortgage at 2.5 to 3.25% interest rates. To put this into perspective, that sub 3% range we saw was the lowest on record since long-term mortgage tracking began in the early 70s. So now those homeowners are locked in at these really low rates. And to give you an example of what that looks like for a payment for current homeowners, a $400,000 mortgage at 3% is a $1,000 $1,686 per month payment. You take that same $400,000 mortgage at 6.25%, and that's a $2,463 per month payment. So that's a $777 increase in your monthly payment, going from that 3% to 6.25% mortgage. So that's a significant amount of money, and that's holding homeowners in their homes. Few of those homeowners want to give that up. So that's another factor that limits the resale inventory, and especially in the move-up price ranges, we're seeing those homes, those sellers are staying in their homes. But still, life happens. People have job relocations, marriages, divorces, downsizing. All of these life circumstances continue to bring some listings to the market, so just at a slower pace. So economists are calling our current market a stall period. So we're in a market that's not falling or booming, but it's holding steady, which means prices are flat. Prices of homes are just keeping up within the pace of inflation. They're increasing about 1 to 3% per year. We're seeing fewer transactions overall, but we're seeing consistent motivation. Buyers are cautious, but they're active. Sellers are patient, but realistic. So this stall isn't a negative. It's a stabilization. It lets wages catch up to prices. It lets inflation cool and affordability get rebalanced before the next growth phase. So some key takeaways: the lock-in effect is still limiting supply. Price growth is steady, keeping up with the pace of inflation. And we're in a stable transitional market, or a stall period, a market that's holding steady. So where are the opportunities in this market we're calling a stall period? Opportunities for buyers. Right now, buyers are in a more balanced position. Affordability is still a big challenge for a lot of buyers, but the market pace is normalized. Home prices are stabilizing. Properties are sitting on the market longer. Negotiations are back, and buyers have the time and leverage to make smart, confident decisions. So I have a story for you that is a perfect example of how being both patient and prepared can make all the difference. I recently represented a buyer that closed on a property. We've been keeping an eye on the market for well over a year, waiting for the right timing and the right fit for her. She had her financing in place. She knew exactly what she was looking for, and she just trusted the process. When the right condo hit, it had west-facing views, the ideal layout. It was priced right for her. She was ready to jump on it immediately. So in a market offering more options, that preparation allowed us to move confidently, write a clean offer at list price, and we even included seller-paid buyer broker compensation. So it wasn't luck, it was timing, patience, and being prepared. In any market, the most successful buyers are the ones who stay informed, are patient, and ready to act when opportunity appears. So things to note for buyers: focus on your monthly costs, the total monthly costs, not just the interest rate. And a great way to keep costs down is to build equity faster is to look for slightly dated homes that you can purchase below market value and improve over time. So overall, buyers have more options, less competition, and more negotiating power than they've had in years, making this a strong window for those buyers who are prepared and informed. So let's talk about sellers. It's still a great time to sell. You just have to play it smart. Buyers today are selective, they have more options, but sellers who prep well, stage thoughtfully, and price with real-time data are still selling fast and strong. So what's selling fast right now? Homes that feel fresh, feel clean, and are move-in ready. Buyers like them to be updated. Think modern paint, lighting, and curb appeal. Curb appeal goes a long way right now. They like the properties to be clean, decluttered, odor-free, well-lit, and properly priced. The most important factor here. We need to price these properties aligned with the current trends, not last quarter's highs. Pricing has to be objective. It's not about what your home was worth a year ago. And buyers don't factor in your sentimental value and decades of memories. They're focused on what the home's worth right now. It's important to focus on the data and leave the sentimentality out of it when you're deciding on list price. So I have a perfect example for this. Past spring, I listed 2 homes that were very close in value and appeal, one in West Bloomington, one in Eagan. Both were in sought-after neighborhoods and near parks and in coveted school districts. Both sellers invested in the concierge list package, so they got the full gamut, the deep cleaning, full staging, professional photography and videography, and strategic marketing. So from a presentation standpoint, they both looked fantastic. But here's where it got interesting. After reviewing the market data, comparable recent sales, actives, pendings, days on market, the Bloomington sellers decided to price at the lower end of the market supported range to spark momentum, attract multiple offers. And the Eagan sellers, they were confident in their updates and location, and they decided to list about $20,000 higher than where the data pointed. They were hoping buyers would stretch for the value, and they wanted to leave themselves room for negotiating. So the results couldn't have been clearer. Both homes started off strong, busy open houses, lots of showings, and solid early interest. When the West Bloomington home, it gained quick momentum. It drew multiple offers within the first weekend and went under contract above list price. The Eagan home also had 2 offers come in over the month. Over the first month it was on the market, but one of them was a bottom line that the seller wasn't ready to accept, and another was contingent on the buyer's home sale, which ultimately fell through when they weren't able to sell their property. So both properties were beautifully presented with lots of updates, but only one was aligned with what buyers were actually willing and able to pay in that moment. So it was just a great reminder that even when the presentation and exposure is there, data-backed, market-aligned pricing is vital. So sellers, make sure your list price is aligned with the current market. Update wisely, think paint, lighting, curb appeal. These can deliver big returns. Prep the property. You want to deep clean, declutter, repair any of those little fixes that have come up that you've just let sit over the years, and then definitely stage before you take your photos. You also want to stay flexible and be willing to adjust your strategy if showings slow down, and listen to the buyer feedback that you're getting and react to it. If they're saying they're smelling an odor in your basement, take care of it. Another thing to consider, you could leverage equity in the property and consider offering buyers credits or rate buy downs too. That can be appealing for buyers today. So the takeaways, the homes that are moving fastest, clean, updated, and most importantly, priced right. So where are the opportunities in this market for the homeowners and investors? So a big one, U.S. homeowners are sitting on an estimated $17 trillion in tappable equity, a huge opportunity for home renovations, long-term or short-term rental investments. So short-term rental friendly markets near lakes, trails, and college towns continue to perform well. I can personally attest to this. My own Airbnb and long-term rentals remain strong. As always, location is key. And we've also seen something else to consider. We've also seen a lot of zoning changes that have happened in 2025 or are coming up here in 2026 in a lot of communities that are opening the door for short-term and long-term rentals. They're more rental friendly, and they're also allowing more ADUs, accessory dwelling units, and guest suites as well. So another opportunity for investors. And then another thing to consider for homeowners, if interest rates ease through 2026, even a modest amount, a refinance saved from 6.5% to 5.75% could save thousands annually. So freeing up some cash for homeowners. So whether you're buying, selling, or investing, the opportunities in 2026 aren't about timing the market. In any market, it's about understanding it and positioning yourself for success. Some common questions that I get: should I wait for rate drops to purchase or make a move? Probably not. Every situation is going to be different, but typically if if rates drop, there will be a heavier competition. More buyers will come out of the woodwork that are also waiting for rates to drop. And then that supply and demand scenario, home prices will go up, demand goes up, home prices will begin to rise. Will home prices fall? Most data shows stability, not decline, because supply is still low. So we're not anticipating a fall. Home prices are still increasing at about the rate of inflation. So they're holding steady. Is this another 2008? I still get that question all the time. No, it's not. Lending standards are strict and there's no oversupply of housing or subprime risk in today's market. So we're not looking at another 2008 crash. To wrap up, the truth is in any market at any time, there's both opportunity and risk. The key is knowing how to tell the difference. Waiting rarely creates opportunity, but preparation and research do. The more informed you are, the more confident your decisions become. So don't be afraid of what's changing, understand it, plan for it, and position yourself to make the right move when the timing lines for you. Reach out and book your 2026 strategy consultation. I would love to help you and take a look at your unique situation and help you prepare for a sale in 2026 or whatever your real estate needs are. Thanks for joining me today. Jen Schlaak with Keller Williams Preferred and Three Keys Real Estate. Look for my next webinar coming up in early December.